And we are live. All right, so I'm sitting here with Van Carlson. You are with SRA 831B admin. And I'm going to ask you right out of the gate, like, it's a long company name. What was the choice on the company name?
Well, it used to be longer.
SRA longer.
Yeah, SRA stood for Strategic Risk Alternatives. That was our company name originally. So during COVID, we rebranded to SRA, and you know, there's nothing like telling people what you do in the name of your company. So there's the 831B admin, which we'll be discussing on your listeners today. So
I was going to say, from a marketing perspective, I appreciate the attention to SEO in the title of the business name. I love that. So tell me, and we're talking about 831B is a tax code,
yep.
and there's 831A, 831B. Tell us what we're talking about here today, because I can monkey around with it, and I guarantee that I'm not going to tell it nearly as well as you will.
Well, I appreciate that, Mac. 831B is really a tax incentive for managing your self-insurance when it comes to your business. And it's been around since 1986. It was introduced very similar in the 86 Tax Reform Act, very similar to the environment we're in today. And when it comes to traditional insurances. And so that's really what it is initially designed for. To your point, there's an 831A and 831B. All that means is in the federal tax code, how insurance companies are taxed. So under an 831A, when you have an underwriting profit, if you're a traditional insurance company, which means you took in more premium than you put out in claims, you have an underwriting profit, you pay corporate taxes on that. In an 831B election, it's really designed for the small to middle, really small property casualty insurers that allows anything under 2.85 million. If you have underwriting profit, is not taxable. So then you can defer taxes. And that's really where we work with a lot of business owners all around the country that are self-insuring risk. And one of the ways that we try to keep it somewhat simple is kind of comparing it to the HSA plans. A lot of our business owners, you know, they're in a position to offset some of their costs with premiums today by taking on more risk themselves, and they fund for that risk through an HSA. And so very similar in 831B. And we kind of are getting the message out there, Mac, that to let people know this is what's going to be going on. I mean, we're speaking at conferences, insurance conferences all over the country right now, with the premise that business owners need to be looking at similar plans like this today, because the burden of self-insuring is going to continue because of what's going on in traditional insurance markets. And we're seeing that across the board in industries right now. Clients are paying more in premium, but getting less in coverage. And that burden of that less in coverage is falling to the business owner.
And so the way that utilizing 831B works is, and I'm just coming at it from, it's good for me because I'm coming at it from an outside perspective. I've never even really, until you and I talked to our planning session, I'd never even looked into it. So it comes across as a tax code where it's a complement to your insurance that reimburses you, or you're set up to reimburse yourself rather, for expenses that are not covered by insurance. Is it a gap coverage?
Exactly. And two, first dollar loss, what we're seeing a lot of right now, and we've actually designed a product called Halo coverage that sits over and above an existing property insurance company policy, meaning that, you know, you hear excess risk with an umbrella. Well, umbrella really covers your liability exposures. And even in that, we're doing policy coverages in that as well, because it's unfortunate, but we're seeing more and more business owners taking on more and more litigation issues when it comes to being sued. And that's a dispute resolution type policy that we offer our clients. But so we're identifying risks that they're retaining on their books. And one of the ways that we simply tell our clients, try to explain it, this program, is there's unfunded liabilities on your books. You know, normally when you fund to fund a liability, you buy an insurance policy, you pay a premium, you transfer the risk to the insurance carrier. They now have my fire on my building, my theft, vandalism, wind, hail, and all that. And then there's things you just simply can't transfer. One of the things that we're seeing a lot of is first dollar loss. We're seeing a lot more deductible increases right now around the country. We're seeing more and more actual cash value minus depreciation on real estate, which means you're losing your replacement endorsement, which before you used to have a replacement, you're seeing less and less of that. So that burden will fall to you, and that's an unfunded liability. And we simply ask our clients, how do you want to fund it? Do you want to fund it with after-tax money or pre-tax money? And if you want to fund it with after-tax money, all I have to say is COVID-19, because that's really what happened, right? If the government didn't step in with the PPP programs and the ERC programs, you were just going to rely on your rent wasn't going to go away, your leases weren't going to go away, your loan payments weren't going to go away, your payroll you needed to. Meanwhile, you had a huge contraction in revenue. The government had to come in, and that's one of the things that we're talking with people all over the country right now. Is what are you doing differently today? If you were relying on those programs back then, what are you doing differently? And this program is really designed to do that, is meaning that if you have this unfunded liability, do you want to use pre-tax or after-tax? And if you want to use pre-tax, then you need an administrator to administer your plan. No different than if I was going to participate in a 401k for myself and employees as a business owner, I need that third-party administrator to administer this plan for me to make sure we keep those dollars tax deferred. So one of the big pieces here is we're going to create a deduction in your operating company level for these risks that you can't fund for today. And then we're going to create that expense. We're going to drop it into an 831B. The 831B really, in essence, needs and looks and feels like an insurance company. Our core competency as a company, as an admin, is administering and admitting insurance companies. So we're not here to complicate our business owners' lives. We deal with a lot of business owners all over the country that have had experiences, and they continue, where I thought I was covered and I wasn't. And now I got this, I had to come out with after-tax money. I had to use my savings, my operating lines, my capital, my business. Now that I've weathered that storm, how do I position my dollars more effectively and efficiently for me? Because now that I'm retaining this risk, I've got to be able to fund for that in the future, because like anything else, we hope it doesn't happen, but unfortunately we know it does. And if you're not prepared for it, you can find yourself in a very dire strait when it comes to running a business.
And yet, so while we're on the topic of business owners, you were just telling me right beforehand that you were talking to an agriculture outfit, and I think that relates to a lot of any of the landowners that listen to this podcast. Sort of tell me what that looks like in terms of a case study, like how that might function to an agricultural outfit.
Yeah, we're dealing with a lot of it with single peril coverages in the dairies and the farming industry when it comes to hail coverage, for example. Hail is getting very, very expensive to the point where it's not worth having, and it's actual cash value minus depreciation, and they're not covering cosmetic damages anyway. Why am I paying this ridiculous amount of premium when I can just self-insure that myself? And that's one of the things we're carving out today, especially with the ag industry. The other ones that we're seeing a lot of is crop insurance. Crop insurance is one of the very it's a first dollar loss, meaning that if I can only buy up to if I can only afford to buy up to 75% of the value of my crop, but it's costing me 85% to put into the ground, I've got a delta of 10%, not alone my profit on top, that be able to afford to keep farming, right? And so one of the things that we start to build for, and it's like anything else, when you're having really good years, how do you maximize those profits? And one of the challenges, with ag is having that first dollar loss. I mean, it's a substantial. It's been said many, many times. I mean, there is no bigger gambler than a farmer, right? I mean, it's just, and especially any farming out there when it comes to that first dollar loss. You got to lose 15, 25% of the value of your crop before your crop insurance even kicks in. But the sad thing is the costs have gone up so much. These guys are running on a lot thinner margins than I realized, honestly. And so that's a big unfunded liability on their books when it comes to crop insurance and what's affordable. I mean, crop insurance is obviously federally backed subsidy. The 86 Tax Reform Act a lot of it was driven through crop insurance. The reason why Congress put this tax code in existence was because private sector was getting out of it. And now it's obviously heavily subsidized. But, there's even been talks about that, unfortunately, about some of the subsidies being restricted going forward. So there's a lot on farmers' minds. Not like there's never not been a lot of risk when it comes to farming and any kind of ag business or any kind of land ownership type situation. When you talk about the political risk we're up against right now and the tariffs that we're dealing with business owners around the country. And I mean, the risk is compounded, unfortunately. And it's just awareness, getting people out there. But one of the ag things that we've been dealing with a lot is the crop insurance, is the ACV on buildings. We're seeing ag right now in tractors. There's gap coverages, meaning that if they had a leasing program and they bought the tractor in the last 2 to 3 years, they actually are starting to owe more on that tractor than it's worth. And of course, insurance companies will only actual cash value cash value minus depreciation on tractors as well. So you don't have that replacement. So we're creating a gap coverage now for revenue. So these are just risks that business owners are always retaining on their books, and how do you position it more effectively? And that's really what we're really good at. And that halo coverage that we've offered our clients going forward in this year is really taking care of the gaps of your policies and exclusions and the limitations. Insurance companies, as a consumer, the burden of costs, you can only burden so much, right? I mean, you're going, hey, what can I afford to pay here? And the insurance industry knows that. So one of the ways that they're handling some of their exposures is they're limiting their exposures, or they're simply excluding them. So if you're paying the same amount of premium you did a year ago, but you got 2 or 3 more exclusions on your policy, you took a rate increase. It just doesn't look like peer like it. If they can reduce their risk, but charge you the same amount of premium, that is essentially a rate increase. It's just, you don't see it as a consumer.
And I think you brought in, I want to ask you sort of about 1099 independent contractors.
Yeah.
Because, again, our listening audience is, a lot of them are real estate agents, people that work with land sales. But you mentioned a really interesting one when we talked last time about coverage in Florida, for instance, with natural disasters. And then we could carry that through. I would apply the same sort of conversation to a lot of those coastal regions that have timber investment land. Natural disasters wiped out timber investments on a lot of the coastal regions, hurricanes in particular. And if I'm picturing this right, what we have is a pre-taxable where this would be taxable revenue coming in, that you basically shuffle aside into a bucket that's there for the rainy day. Is that kind of?
That's 100% it. And
okay.
And business owners don't have a lot of incentive to save, right? I mean, we've got all the reasons to spend money with this 172 accelerated depreciation and everything else. This is the one tax code that incentivizes business owners to save for that rainy day, right? And we know that's coming. It's just, here's what I would tell you, especially with the ag or any subcontractors or anybody else, there's peaks and valleys in any business cycle. And when you're at a peak, buying more things and taking more risk. I mean, that's one of the reasons I got into this, honestly, Mac, was in 2008. I mean, we're being here in Idaho, leading up to 2008, I was a traditional insurance company. I was a traditional insurance agent. I sold a traditional insurance. Most of my clients were general contractors and subcontractors. And I loved the fourth quarter too, because every fourth quarter they sat down with their tax planning, and basically tell you what you need to pay. And then they call me up and say, hey, man, I'm buying 2 more trucks and a skid steer. What's it going to cost to insure? Of course, I loved that too. I was making more money. The sales guys were making more money, but all the contractor did, or the farmer, anybody else in that, they just bet next year was going to be better than this year, which is a form of insanity when you think about it, because they took advantage of the 172 accelerated depreciation, but then they took on debt for the following year. So next year had to be better. And of course, when 2008 and 2009 hit, we saw a lot of my clients go out of business, unfortunately. I mean, loans and covenants of loans started to mean things, right? And so that's where I thought there had to be a smarter way of running a business, and it's just not always doubling down that next year is going to be better than this year, because eventually you're going to get caught up in that deal, right? And we see that, right? And maybe we're going into that now. I don't know. It doesn't feel like it, but we know economies go up and down all the time. So
and I'm thinking about the setup for this. If a company, or in this case, an independent contractor, or somebody operating a business, basically, if somebody is exploring this as an option, do they have to have, in order to run exploratory on this, to set it up, do they have to have a healthy amount of margin already on the books? Or is it something that, like, if they're over leveraged, is something like this still possible in terms of cash flow? How does that sort of function into when you're helping them structure their business operations?
Great question, because you're absolutely right. This is a forced savings account. And so if you're in a growth mode to the point where every dollar you're making, you're pouring back into your business, this probably is not a good time for you. honestly, because you got to take some, you got to take some profits off your balance sheet and move it into an unrelated party and build it, to your point earlier about building that rainy day fund, right? So it really depends on the level of you're at in your company and what your growth. I will tell you that most of our business owners, most of our clients, which we're the largest manager of 831B plans in the country, we manage close to over 800 of them, is really a company that's mature and they're kind of in their 50s, and the couples that own them, business owners, partnerships, and they're looking at other ways of either eventually, hey, we're going to be selling this thing in the next couple of years. Hey, I'm tired of taking more risk. And also, I would tell you that now their tax liabilities are up high. And, there's nothing worse than I hear to say a business owner that took an idea, ran with it, turned into a profitable business, and then say, hey, I'm done growing because the more I grow, I just pay more taxes. Why the hell am I doing this? And there's nothing worse for me to hear that. And these are people that we need to be able to, we need more of them, right? I mean, that our country relies on small to middle market business owners in our country. And one of the things that, this disturbing when I hear a business owner say that, and I'm like, hey, this is another tool you can have on the books that allows you to start taking some risk off the table and recognize the risk you've been taking and how do you position dollars more effectively. And so I think I tell business owners, I work with a lot of upstarts, and we start to look at, we can create additional revenue for them too in these programs under their warranty programs and extended warranties and service contracts and all that kind of thing. That's a whole different animal. But we do that's kind of where I cut my teeth, honestly, is dealing with dealers and auto dealers and all that, selling service contracts. So we can actually create additional revenue too in the business. It depends on the industry they're in. But eventually it's a thing called enterprise risk management, where you start to look at, your brand protection, supply chain risk, dispute resolutions. Am I covered enough for cyber, employer liability practices, foodborne illnesses, all these other things that get very complicated in the world we're in today. That's an enterprise risk management strategy where, you do start to recognize a lot of self-insured risks that you're taking on, and how do you want to position dollars. But it is a maturity, to your point. I think it's a point we're taking and making, is for sure that there is a point in time in your business cycle when you want to start taking risk off the table, and we can be a complement to that. Absolutely. So,
and I'm gonna take a gamble here as far as business theory, as far as how this can function is it. And shut me down if I'm completely off base. But when you often get to the end of the year and business owner A goes into their accountant and they get the advice of, hey, you've got some taxable liability here, or you got some taxable income here. I'm trying to get my terminology right. You got some taxable income coming in here. And what I advise you do is go out and buy a brand new truck to reduce your taxable. You know what I'm talking about.
I deal with it.
It seems like instead of, if you've got perfectly functioning equipment and your account is telling you to go out and buy some new piece of equipment to offset your taxable liabilities, you could be just offsetting liabilities and stuffing into a bucket of hey, now I've mitigated some risk, instead of gone out and getting something that's depreciable. And like you said, if you're not paying cash down, it can depreciate faster than what you could get in return for it. And so now you're just sitting on it hoping it doesn't break down. Am I kind of on base here? Or?
No, you're 100% right. We're very busy in the fourth quarter. And so I would say that, no, you're 100% right. And that's just, the business owners only know what they know, right? And they're being told by their tax advisors, or tax planner, or what I'd like to call a compliance public accountant, where they're more worried about being compliant with the tax return than they are really doing tax planning for their business owners, and telling them to buy more equipment, not recognizing at all that there's no risk in doing that, right? I mean, you just, the fact that it's a depreciating asset, the fact that you leveraged, in fact, that next year, now that I got a loan payment, I keep betting every year is going to be better than the previous year. And this is unfortunate. This is where a lot of business owners, they're good at their craft. They're good and they're learning the business, right? I mean, they're trying to become better business owners, right? And they only know what they know. And the unfortunate part is when they do have CPAs, and believe me, I get a lot of CPAs tell me that I never tell my clients to do that. And then I'm going to go, well, how do your clients know that then? because they seemed like they all knew it back when I was doing this in 05, 06, and 07, and all the contractors were making a ton of money back then, because I mean, so many homes were being built everywhere that they all knew to buy more equipment. Well, who was telling them that? And so, but it's easy. It's easy to say that, right? Go buy more equipment, take the 172 depreciation, right? But to me, it's just a form of insanity. You're just betting every year is going to be better than the previous year, and to me, that's not good planning. And that's really where it rocked me hard back in 08. Thinking back, because I knew a gentleman that had 8 of these things in place, 831B plans in place, and he was a manufacturer of RVs. He took advantage of the market because he had piled up cash leading into those 08 years. Well, he was the only one showing up at the auctions buying raw materials for 10 cents on the dollar. And that's when the light bulb went off for me and said, well, wait a minute. Why isn't all business owners doing this? Now, not all of them will do, because they love to, if they're keeping up with the Jones, to your point earlier, if they're keeping up with the Joneses, they want the new boat, the big house, all of that stuff, we're probably not your client. You're probably not a client for us. But if you want to start getting into the mentality of saving and positioning, and additionally having additional revenue sources down the road, not just your primary business being and not you being your baby that someday you're going to sell it and come home with millions of dollars. I mean, that's kind of what business owners, I'm a business owner, we all kind of think about that stuff. But the reality is I have incentive to save money, not spend it. Well, that's a mindset change, right? I mean, honestly. And so I think what you described it was exactly what transpires throughout the year for business owners, and it depends on where you're at in your cycle of your business. We hope all of our clients eventually become customers of ours, but we also recognize that there has to be a maturity, an evolution of the business to get to the point where, hey, we got to start setting them up. We are incentivized to save money for a rainy day going forward, and that is a mindset flip, honestly.
So I think conversationally, this is a good lead in. I mean, we can't get out of the conversation of 831B without going into the risks, and 831B has been put into what did they call the category, the dirty dozen or whatever, with the
they didn't do it this year.
Okay, so
I have no idea why. I don't know why the IRS chose not this year. They just put new regulations on us too. So here's the deal with that. The code was hijacked. I'll call it was hijacked. It was hijacked really in 2000s.
I was going to say, you were just talking about the keeping up with the Joneses. What I'm guessing is there's plenty of people out there that had their rainy day fund, and that rainy day fund was, I need a new sports car, and they put money away, and then they get the new sports car out of this revenue that was not taxed, and it should have been put towards risk, and now I've got a new convertible.
It was all of that. And life insurance. There's a lot of life insurance guys out there selling this for life insurance, using tax deferred dollars to fund a tax-free vehicle. You can just imagine how that cycle sounded to the IRS. Like, oh, this sounds like tax-free income. And they were promoting it that way. And I will tell anybody, any of your listeners, if you ever had somebody tell you this is tax-free income, somewhere it's not easy to do. I mean, our government, honestly, is probably one of the most aggressive tax revenue drivers in the world. I mean, I hear it from all over the country and all over the world that, expats are still paying taxes to the U.S. I mean, it's not an easy. If it sounds too good to be true, then guess what? It is, right? And that's that old adage. But they were doing it for estate tax planning. They were doing, making the ownership, because this box is a C corp, right? So you the shareholders, so if you make your kids the shareholders or irrevocable trusts, and you're transferring liquidating your estate, and it gets really complicated on that front. And believe me, there's folks out there that have estate tax problems. I get it. There was a huge incentive in 2000s and in the early teens to do these types of programs because the state taxes were so low. That's not the case so much. And now there's an ownership test. So you can't play those games as much as you were able to in the past. But yeah, honestly, the IRS still doesn't like these things. We're still seeing abuse out there in this code. I tell business owners all the time, if your sole purpose was to avoid taxes for the time being and defer those taxes, and that was your biggest that was the biggest thing you went into an 831B for, then you probably shouldn't be a client of ours. If you're doing it for risk management with tax incentives, that's our client. And honestly, the conversations have changed so much over the years, Mac, that it's about risk management today. Honestly, the traditional insurance companies, and besides the complication of just risk overall, but when it comes to traditional insurance companies restricting more and more and putting more exclusions in their policies, and then they're worried about even submitting claims because they have to have insurance programs. Like a good example is your subcontractors. They got to have a good A-rated carrier to step on those job sites. They got to show proof of insurance. If they start to have frequencies, or they start to, some of these guys, hey, if it's less than $50,000, we're just going to take it on ourselves and we're not going to submit it to the insurance carrier. Even though my deductible might only be $5,000, I'm not willing to submit the claim because I know it's going to happen. I might lose my insurance program and I can't do business with that general anymore because he's not going to accept my certificate. Or I'm working with a big company that requires a ton of insurances for me to step on their job sites. And that's a risk I'm not willing to take. And I'll just take more on the chin. And we hear that more and more. And I heard that a lot when I was in traditional insurance. Hey, if I turn this in, what's going to happen to my insurance program? And now I can tell you right now, we're in a world right now where if you start to have frequencies of claims, and I'm dealing with business owners all over the country on this. We also replace traditional insurance too through a macro captive, right? We deal right directly with the reinsurance companies. I have a sister company called Insure Edge. We're really good at, if you pay high enough premiums, which is $500,000 or more to traditionally through work comp, general liability, commercial auto, and excess risk, we can start to look at replacing your traditional insurances as well through this program. But the thing about that is even that even gets a little dicey when it comes to it's just a different world today when it's, do you really want to submit a claim or not? And here's the thing, I don't know if that's going to change anytime soon. I think the insurance industry is going to continue to harden. I think the burden to the insured is going to continue to fall to them, but they're going to find themselves self-insuring more and more of their own risk. And really, I appreciate being on your show because it's just getting the education level out there. To your point earlier, like you said, hey, I wasn't even familiar with this code, right? And even though it's been around for almost 40 years, and I will tell you this, the biggest adopters of these were the Fortune 500 companies, people that you have to compete with. If you're publicly traded or you're a large company, you've been self-insuring your own risk anyway, because nobody was selling you product liability insurance or your own GL coverage, or you're just a more bigger appetite to take on your risk yourself, that they all build their own insurance companies. UPS owns more insurance companies than any major company I know. And it's all for their damages on their it's a great revenue source for them, and it also protects them for taxes. It's just an efficient way of running a business. So we're trying to bring this idea and concept down to those smaller to middle market business owners and say, hey, you can play in the same arena here. And if you're having to compete against these types of guys that are doing this, it's just they're managing their tax burden better. That allows them to run their business more efficiently, honestly. I see it all the time. I see it, especially with subs on bids. Let's say you've been doing our program for a while and you've got this money banked in the back room. You can get more. I've seen guys get more aggressive with their bids because, okay, if they don't bid it right, or if they have to do a rework, let's say they're a paver and they had to do a rework, they can put that dollars back on those profits from a couple of years ago because they got it set aside, so they can get more aggressive with some of their bidding that they may not otherwise, because the risk reward's not there. Hey, I don't want to get this aggressive with it because my reward may not be high enough. But if I piled dollars away during those really good years, I may get more aggressive on my bidding. And I think that's an efficient way of running your business.
And then I want to go into definitions a little bit. So these fit into a category they call micro captives. Is that sort of the umbrella term for, does that take in 831As and Bs, or is it just the 831B? Educate me too on the 831A as far as differences.
Yeah. So the 831A just means your underwriting profit's taxable.
Okay.
So let's say if you put $1 million in this thing, at the end of the year you had claims, but it was only $200,000, so $800,000, you have to pay corporate taxes on that. At 21%
for the year is okay.
That's an A. An 831B says as long as you've paid less, as long as your insurance company took in less than $2.85 million, and it's underwriting profit. So let's say the same scenario, that $1 million you put in, you have $200,000 in claims, that $800,000 becomes underwriting profit. Under the B election, you don't pay taxes on the $800,000.
It's just stays in the bucket.
Exactly.
Okay.
Now, the only thing you do pay it on is realized investment gains. So let's say you put that money in a money market account, or you had your financial planner manage the money and you had dividends. You're going to pay corporate taxes on the realized investment gains under the B. But as the premium stays tax deferred, and what it's designed to do is to build the surpluses up so you can take on more risk, you can handle more risk. You know, and it's 2.85 million. I can tell you this: our average client does about $300,000 a year, and it's really, we have our own methodology. Just because you can do that much doesn't mean you get to. There has to be a process, through an actuarial process, through a pricing and methodology, what you can and can't do. And that's one of the things that also gets you in trouble with the IRS too. Is like relative to the risk you're taking, you're overfunding for the risk, right? Are you really looking and feeling like an insurance company? That's probably the biggest thing that the IRS gets after. And I will tell you this, we've gone through our 6,700 promoter audit. What that means is if you're out promoting a tax code like we've done through the 831B, eventually you'll get the attention of the IRS. We started our promoter audit in August of 22. It closed June of 24 with no changes on our end. And so we received our letter saying, hey, we're shutting down your audit. Of course, don't read anything into this, but we're not going to continue with your audit. And so that was something that most of us, a lot of promoters don't get that letter a lot of times. And so I'm not saying that we're angels by no means. We've had to learn the hard ways on some things. We haven't had clients get change orders when they've gotten audits. Some of the misnomers is if you have in one of these plans, it's going to trigger more audits. We have not seen that evidence whatsoever. And we've been doing this for almost 18 years, really since 08. So, that's kind of our space. I think if you're doing it for the right reasons, and believe me, there's a 4-part test to this. There is some, there's an education to this. And that's the thing I would bring up too about your business, about our typical business owner. Our typical business owner is really a business owner that has achieved to the level where they're working on the business, not necessarily in the business all the time. So that's another mindset that we deal with as well, that we have to recognize with our clients is like, where are you at? If you're in the day-to-day grind in the minutia, again, if you can step out of that, great. But unfortunately, a lot of our business owners, they're in it, and that's okay. It's just these are one of these tools that you really got to sit back and look at and do your own due diligence, do your own thought process, learn as much as you can about it. You're competing against people that are doing this, which gives, again, earlier, like I said, does give you a competitive advantage long term if you start to really dial into this thing. But at the same time, it's another tool in the toolbox for you. I think business owners, the amount of risk we all take to do what we do, you got to utilize every tool that's available to you. And that's all this is. And at the right time, it's a great tool. And that's what it comes down to, is timing. Where are you at in your business? Where the evolution of the business? And really, are you to the point where the risk reward isn't there? Then, can we make it more incentivize you? And believe me, Congress knows what they're doing. They create all the incentives in the world, right? And I would say the behavior, the Boston Tea Party is a real thing. Business owners don't like paying more taxes than what they have to. And I get all of that. We take a lot of risks to do what we do. And sometimes, when you hear things of what's going on in the federal government, it's like, why am I doing this? Why am I paying more taxes and taking on more risk? The reward's not there. Why am I doing this? And there's nothing more discouraging than that to hear from a business owner, especially a successful one, that, how do we create more reward is utilizing an 831B.
And it sounds like that was going to be one of my questions, is whether you have an increased audit risk. And from what you've said, it sounds like there's a scrutiny that is going to be there that you're not going to see otherwise. Like your typical taxable year, you're going to go into it and you're not going to face scrutiny, but you are going to be scrutinized that, like, you didn't set aside $1 million to cover paper clips, right? Like that's going to be an overfunded account, and they're going to come back to you and be like, nah. Come up with some other risk, or you're going to have to part with some of that fund. But in terms of a full-on audit, you're not as, it's going to be a typical sort of process, and whether the dice fall in your area or not, and you get the audit, just depends.
Right. But having an 831B plan does not increase your chance of an audit. We have not seen that personally at all. And I think the other thing about that is, you know, just given what's going on with the IRS right now, there's going to be a change coming on the horizon with the 831B. We do think we're talking to enough insurance commissioners around the country. We're talking with enough Congress leaders, bringing this to their attention. You know, it's been around the books for a long time, but a lot of the congressional folks didn't know this code existed. And ever since, you know, the last 4 years since COVID, we've been sitting down with congressional leaders all around the country, explaining to them about this code that, hey, this should have been the PPP all along. This should have been the ERC program. You guys should allow business owners to put away their own rainy day fund and not be relying on the government going forward. Because the problem today is, what are we doing differently? Are we going to really go, God forbid, if another COVID was to come in, are we really going to go back to do what we did? Because we're still paying the ramifications. We still don't know all the ramifications for what went on in 2020 and 2021. And so this is getting a lot of traction around the country. So I would tell you this, Mac, in my opinion, this will become a normal business practice, no different than the 401k. A couple of things need to drop to make that all happen. But I just think hey, there's great tax incentive to it, no doubt about it. You're deferring taxes in the future. No different than 401k. The only good thing about this is it's a C corp, so you do pay long-term dividends or capital gains versus ordinary income. That's the big difference between 831B and the 401k. And like I said earlier, it's very similar to HSA. I don't spend it. You know, eventually turns into a retirement plan for me down the road, and that's what I ultimately hope. Ultimately hope that happens for all of our business owners, that they don't need our cover. The rainy day fund wasn't used. Good for them. It just becomes another asset for them down the road. And that's rewarding the business owner to take the risks that they did, because I do think we're in a real big danger in this country if we don't create more incentive for business owners to want to run a business. You know, you talk about this huge transitioning of wealth in our country. Well, most of that wealth comes from small business. It's not a retirement account they're going to inherit from grandma. That's not, you know, it's the business that grandma and grandpa is still running is the concern. Who's taking that business on? And that's one of the things that we see a lot of around the country right now. It's kind of shocking to hear 3 million small businesses are owned by people that are in their mid 60s and early 70s. And you're like, well, where's that going? Who's going to run that business? Who's going to own that business? And this is getting back to that risk reward. And I think we ultimately, we hope the reward outweighs the risk. And I think one of the things that you can utilize is a tool like 831B to get there.
Side question, because you got my head going. Can an 831B be utilized to offset the risk of human capital?
Yes.
Because that could be, I was going back to real estate. I always get really interested in the real estate industry because when it comes down to valuations and risk, and a lot of people will build up the real estate practice, want to sell it off like small brokerages, and they're like, yeah, come on in here. I want to sell it to you for $3 million. It's like, well, here's the deal. It's only worth you as human capital because you've done your deals, you have your book of business, but that doesn't mean people are coming back. People can go wherever they want. And the real asset of the business is you as a person, and you can leave at any time. And so I see potential there to offset human capital risk, like injury, sickness, any of those kind of things or leaving or an employee leaving. There's a lot of variables here.
No, there is. And we call it rep and warranties. So it's called transactional risk. So we actually, we help business owners all over the country sell their businesses from the standpoint of like we're acting like a bond company. That meaning that, hey, some of the sales of the proceeds will we'll park those aside. And if anything was to happen here, we got a bucket of money to pull on. We see it a lot in the subcontractor world where they've done a lot of warranties. I mean, subcontracting world, especially in the HVAC, plumbing, even electrical, we're seeing a lot of warranties. Well, the problem is when you go to sell your business, the buyer likes to devalue your business because, hey, I got to honor all your warranties going forward. So what we do is we'll set dollars aside in the sales process, say, hey, wait a minute, if you have any warranty exposures, these are the dollars you're going to pull from. So you're not devaluing my business because we've got that handled. And that also makes the sale possible, honestly. And so those are just value adds that we can bring in on top of that. And believe me, leading up to COVID, we were doing a ton of transactional risk because there were so many businesses selling. Now we are seeing a spike in that right now, which is great. I'm happy to see the small businesses available. And we're seeing a lot of from venture capital companies coming in, buying a lot of subcontractors up. But, you know, they're getting pulled into these things too that says, hey, you know, we just want to be able to converse with that and say, okay, here's a better way of doing something, or here's another tool that you may want to consider in the selling of your business. And it's been a huge success for us, quite honestly. We run a tail policy, especially if you're going to, well, we see a lot of clients holding notes. You know, if you're going to have to hold back your note, because, you know, one of the things that business owners value typically is the intangible asset of the business, and that's their blue sky, right? The contracts, reputation in the community. I mean, all of those things, and your client base, to your point, especially with the real estate, you know, the real estate broker is going to stick around. You know, what if I have to enforce a non-compete? Where's that dollar going to come from? That is, you know, these contracts are only as good as you're willing to enforce them legally, right? Which is not cheap to do by no means. And so these are just things that you can start to think about. Again, adding to that rainy day fund to be able to handle that transition to where, again, the reward is worth taking the risk. And that's kind of where this thing balances, you know?
So I'm gonna pivot here to I'm gonna call it a blatant promotion, but I'm gonna work around into it because you know what I'm getting here and what, you know, from the research I've done before this, which all of my, like, you know, few hours of research is not going to equal your 18 years, but to get my head around it, dug in, there's increased scrutiny when you do it, but, you know, again, not an increased liability of audit, but you are going to be looked at a little more as far as if you're doing things right. There is a tiptoe that you have to run. You've got to make sure that you properly assessed your risk in order to fund that risk. And there's not many companies, I'm guessing, out there like you. To me, this speaks to, you've got to have an administrator that has their junk together when you go into something like this, because if you don't, that's when you get yourself in the hot water very quickly. Then, you know, the IRS comes looking at, like, that's a really nice new convertible you've got there, and no, your pencil holders weren't worth $1 million. I'm sorry. Yeah. Now you're in trouble. Like, it seems like those kind of things could happen. How, you know, one, how do they, what do people need to know to find a company, and how do they find you? Because you obviously are experienced with this, if they want to get educated or go through the process. No,
great question. I would say this. One of the things that makes us unique is we don't manage the clients as assets of the plan. No different than a 401k administrator. 401k administrators do not manage the money of that plan. They make sure you adhere to the rules and regulations of that. So and we mimic that program where we know our lane. We are a manager of insurance companies. We don't manage, so we don't dip our pocket. A lot of our competitors like to manage the reserves and the surpluses and everything else, and that's another ad revenue that they do.
That just sounds like management fees.
It is.
Okay.
And so we stay out of that game. We just don't. We're happy to work with our clients as financial advisor if they want to manage the asset of those plans. That's no problem for us. And there's an agreement when you sign with us, what you can and can't do with the reserves and the surpluses at any given time. But nevertheless, we're not managing. So I do think that makes us unique. And I would tell you, if a manager was to do that, they're going to try to sell you life insurance. They're going to try to do all these other things that they're looking for other revenues other than what they're charging to administer the plan. I
was just going to say, it's an opportunity, because and what you're talking about is you're offsetting cost. You're running pass through and letting people not have to double dip, and as far as, sorry, not double dip, but double pay, because then they would be paying you for management fees, and chances are you're just passing that along to a different financial advisor who's also got management fees, and you're both just collecting revenue off of the money you're offsetting for the client. And instead of that, you're just creating the plan that they're going to go through somebody else. Okay. I think, yeah.
And so, and we do the tax returns for these vehicles. We do, so we get all the reporting, we get all the 1099, we do all that on our behalf. We do the financial reporting, and then we hand it off to a third party CPA firm that's independent of us to do the tax return of the C Corp, the 831B plan. So we see what's going on out there, but at the same time, we don't get anybody's pocket on that. I think that makes us unique. So that's one of the things I would definitely look for if I was a client looking for who's managing this reserves, and if it's a person that's managing my 831B plan too. I see that as a direct conflict of interest personally. The second one is are they a CPA or attorney? Most of our competitors are law firms, and they're doing it for asset protect. There's alternative reasons why they're doing it. It's still asset protection, and it's still also doing a state tax play, because attorneys can get much more clever than I can. I'm a risk manager. I'm not, little boring. I'm not the most exciting guy to talk to at a cocktail party, let me tell you. But I can tell you everything that's going to go wrong on something. But at the same time, I would say as long as your 831B is first and foremost risk mitigation, risk management, and designing 831 and a lot of history with it, and gone through a 6,700 promoter audit. Those are all things that I would absolutely, in fact, on our website, by the way, our website's 831b.com. There's 10 things to look for when you're looking for a new manager, for an insurance manager out there. And essentially that's what we are. We're managing your insurance company. And we're certainly not here to complicate. Sometimes this starts to sound really complicated, and we try to simplify it the best we can. But that's where you have to work on it, not in it kind of business. At that, you got to flip that switch. But we're not here to be we're here to be a complement to your business, we're not here to complicate your business. And I think we do a really good job at that. And I think our track record kind of shows that. And but those are some of the key things I would always look for. I'll be honest with you, I see more and more managers coming to the table. They're still mostly CPAs and attorneys. I'm working with some key aspects around the country for some risk management not facilities, but really facilitators that are risk managers that are utilizing our programs. And because we're working with business owners all over the country right now, risk is getting more and more complicated, and it's not getting easier out there to run a business, unfortunately. So.
Last question, and because I want to be respectful of your time, I don't want to take up your whole day here. I meant to ask this earlier because we talked about, you probably want to be generating margin and having to look at what to do with that margin. What would be, and this is, I live in a world of it depends. So my next question is going to be, what is a certain amount that somebody would want to make sure that they have in order to be able to do one of these? Like, I'm guessing it's not $50. Like,
no.
Is there? Do you have sort of guidelines for that, or is it you just need?
We do, but I'll say the word. It depends.
There it is.
It depends on the industry they're in, right? I mean, honestly, I will say that it's crazy the industries we find ourselves working with. I mean, one of the great things we get to do is work with business owners that have found a unique way of making a living and are very good at it, and their margins are sick. It's just crazy. They actually have a lot of exposure because the insurance industry doesn't do a good job with them because they're really unique, and they just, they have this policy, and they said, okay, we'll classify you in here, whether or not you should be or not. It's just easier for the insurance industry. So we really dive into that kind of a situation. So I would tell you, the number, at least 100,000 a year, was probably the low end threshold. And then it's a long-term planning strategy. That's the other thing too. We tell business owners, this needs to be looked upon as a 5 to 6 year runway. Before you go dip your toe on it. There'll be years you can't fund, and because of the 172 made sense. Hey, I got to go buy more equipment, so I don't have my tax liability. Or hey, the economy stinks this year, so my profits aren't there. That's okay. It's just that long term, it needs to be thought about over a period of time, not just in 1 year and out the next. I don't think that's the way this program should be looked upon. And just because you have a big burden, just because you have a great banner year 1 year, and you say, hey, I want to take, the I.R.S. is probably going to question that as well. But if you're in this for the risk mitigation and the long-term planning strategies that come with it, then I think you can sleep easy at night knowing that you're protected in other ways you weren't before.
Awesome. Well, Van, I want to give you an opportunity here for a shameless plug, as far as tell people how to find your company, how you work with them. What's your team look like? anything you kind of want to plug here.
Yeah, no, great. I appreciate it, Mac. So 831b.com, we made the website in a way that is educational, due diligence. There's case studies on there. There's some animation videos to kind of explain this in more detail. We have a really robust team. I would consider us all risk managers for the most part. We do a full assessment for our business owners. If some client comes to us, we ask for all their policies. I thank God for AI today, because we're able to use those documents and feed them. But our prompting library and everything we've been able to build over the years and really dive into these policies to show business owners, hey, you're self-insuring here, or hey, you have a limited coverage here. Here's how we can help start to build that rainy day fund up. So if any of these things were to happen, you can pull from previous year's dollars, not the current capital you're in today, right? So that's where we kind of start. And then, and it's the education process with business owners. You can reach me at van@831b.com. That's VAN at 831b.com. Happy to take any questions or listeners and concerns. I mean, if you've been in business long enough, unfortunately, we've all had experiences where, hey, I thought I was covered and I wasn't. Or, hey, I know I got a big gaping hole here that I need to fill somehow, because I'm not willing to take on more risk going forward if I can't do something about this. And that's really where I think we can bring in the unique ideas and strategies that maybe a lot of business owners weren't even aware that it's available to them.
Awesome. Well, Van, I thank you for I'm glad your team reached out to my team, because it's been a really educational topic. It's been absolutely fascinating, actually. A lot of value to this conversation to anybody listening, I think. So thank you for your time. I really appreciate it.
No, thank you, Mac. Appreciate being on your show, man.
Excellent. Well, I'll have links in the show notes. Anybody listening, just check out the show notes. You will be on YouTube and all of the typical podcast outlets, so the links will be live. Check out 831B, and yeah, Van, thank you.
Thank you, Mac.